Friends. Today I have details about five companies where an ace investor like Vijay, Kedia, along with other ace investors, hold a substantial amount of shares or some uh, value part of shares in company with a corporate annual growth rate of about 87% on a 5-year revenue basis. So. Uh, it generates some curiosity for understanding the kind of shares held by these investors. First of them is Elcon Engineering, 14,000 crore market cap, price 644. Stock is up 2% on Friday. Revenue stream you can see increasing over CAGR 15%. We'll quickly go through that in the later part of the video. Uh, Elcon Engineering Company Limited is involved in the design and manufacturing of industrial gears and material handling equipment, and is involved in providing erection and commissioning solutions for its products. So rather, it should be customers. Then the second company is NCC Limited. I did a video on this a few days ago, about 2 to 3 days ago, on NCC. It is a company with 13,900 crores. The shares held by Mrs. Rekha Jhunjhunwala, which is about 12.48% stake in the company. So again, is an ace investor with a huge value. So we won't really go into the details of this company in the later part. We'll just quickly go through what it does. It's a reputed company, so it's engaged in the infrastructure sector, primarily in construction of industrial, institutional, hospital and hospitality and commercial buildings, airport housing projects and transportation projects including roads, bridges, flyovers, metros and tunnels, water supply and environment projects, railway projects, electric distribution, transmission lines and smart meter projects, irrigation projects, mining projects and more. So I had done a video on this company NCC 2 3 days ago. Probably if you search through Facebook under my profile, you may be able to see this either under this profile, or there is also another profile with the same name, Raja Bakshani on Facebook. You will find it there, and it's a comprehensive video covering all the aspects of the analysis in terms of revenue, in terms of profitability, in terms of shareholding and stuff like that. Then the third company is Zota Healthcare Limited, 2,742 crores, 943 rupees, up 2% with ace investor Mukul Mahavir Agarwal holding 2.5% stake in the company. We won't look at the financials, we'll cover that in the later part of the video. Is a drug development, manufacturing, and marketing company offering a wide range of pharmaceutical, nutraceutical, Ayurvedic, and OTC products in India and overseas. Then the fourth company is Beta Drugs Limited, market cap of 1,791 crores. This is also a company we did about a week or 10 days ago. You can also find the video of this or some pictures of the financials and the company information through my Facebook profile as well. So it is a company held by the ace investor Ashish Kacholia with 5.7% stake. So it has a CAGR of 32% in the last 5 years, which is amazing. It's engaged in the business of manufacturing a wide range of oncology and anti-cancer drugs in India. Then the last company that we are covering today is Tejas Networks. It has a market cap of 12,500 crores, 709 rupees is the price, held by Vijay Kedia via Kedia Securities Private Limited, holding 1.02% stake in the company. We won't go into details of the financials here. You can see CAGR of 87% in the last 5 years. So again, it's a huge jump in terms of revenue growth. Tejas Networks is a part of the Tata Group, is one of the leading indigenous developers and manufacturers of telecom and networking equipment, specializing in both wireless and wireline solutions. The company designs, develops, manufactures high-performance, future-ready products for building high-speed communication networks that carry voice, data, and video traffic from fixed line, mobile, and broadband networks. So, important disclaimer before we go into the financials. The article come information has been extracted from the various different resources on the internet. All investment opinions and recommendations mentioned are solely those of the expert broking houses and rating agencies. These views do not reflect any personal opinion or advice. Stock market investments carry inherent risk of financial losses. Investors must exercise their own judgment and conduct proper due diligence. The author bears no responsibility for any losses resulting from the decisions based on this article. It is strongly recommended to consult a qualified financial advisor or broker for getting before making any financial investments decisions. So this is the first company, Alcon Engineering. Uh, this is another picture of how it works. This is probably the logo of the company, one of their products displayed, as installed. Then you can see last 5 days, current price of 635, 6.5% down in the last 1 month, 5.5% up in the last 6 months, minus 2.8% over the last 1 year, which is a negative return. We've been through the basic information of this company. Stock price to earnings ratio of 34, 633 is the price. Dividend yield of 0.32%, return on equity is 23%, face value is 1 rupee. Company is trading 7 times its book value. You can see sales have been consistently growing in the last 1 year. The sales have nearly uh, yeah, the sales have doubled in the last 1 year, in the last 4 quarters rather. Profit has also doubled, exactly doubled from 73 crores, has gone up to 146 crores. So it's a great, financial performance in the last 1 year. You can see here, uh, overall, you can see the sales between year to year. There's about 10-12% growth in revenue compared to the previous year. Net profit, you can see about 20% growth in the last 1 year. Overall, you can see sales growth 15% in the last year, profit growth of 17% compared to the previous years where the average profit growth was 42% and the average sales growth was 22%. Last year hasn't been that great. Stock price has gone down as well because the performance has not been up to the previous performance or expectations of the investors or the market. The return on equity has been around the 23% mark in the last 3-4 years, which is a good sign. Then you can see reserves have grown by about 400 crores, which again is a positive sign. Then we will look at 28, 27%, as in public holding is still high, leading to price volatility and volume volatility as well. And we've ignored NCC since it is something that we've already covered in the recent video, and the company seems to be doing pretty well. You can find the video on one of my Facebook profiles. Then the third company is Zota Healthcare. You can see it's at a minus of 6.8%, 12.8% positive return in the last 6 months, 58% return in the last 1 year, which is substantially well to do. Since it's a new company, it's a pharmaceutical company, manufactures, markets, and exports pharmaceutical, Ayurvedic, nutraceutical, and OTC products across boundaries in the semi-regulated and regulated markets of the Asian countries, African countries, Russia, and Latin America. Price of 936, book value 78 rupees. So, company is trading 12 times its book value. Company is giving negative return here. So a word of caution: the company probably is a new company and is highly overvalued in terms of price. face value is 10 rupees, and if it's not giving you any return, it's not worth investing in the company. We look at the financials here. You can see 12 times book value trading, low interest coverage ratio. Promoters have decreased the holding in the last quarter by 4.3%. Low return on equity of minus 23% in the last 3 years. Sales have grown, however, company is at a loss, almost about 55-60 crores a year. So not a very good sign. You can see minus 57 crores in the last 1 year. The previous years, the loss was 6 crores, 14 crores. So situation is getting worse for the company. Though sales have increased, the losses have also increased. You can see yes, sales have grown by 62%. However, if the sales do not realize into profits, then it's not worth keeping or staying invested in such a company. My suggestion would be to completely ignore this. You can just treat this information or this company as a sort of information that you may come across by ace investors who invest in these stocks, hoping that the company would overturn and turn profitable after some time. So I hope that whatever investments that they've made, they are able to recover their investments over a period of time. Then the fourth stock is Beta Drugs. This stock was also covered in detail about 8 to 10 days ago. Engaged in manufacture of anti-cancer drugs in India, exports and produces for the domestic market as well. High of 2,215, 1,800 crore market cap, price of 1,774 currently, price to earnings ratio of 39, which is pretty high. Book value is 195, so the company is trading at almost 9 times its book value, so that also seems to be high. No dividend paid. Uh, Return on equity is about 26%. Stock price is 10 rupees. Company hasn't paid any dividend. Company has delivered good profit growth of 37% CAGR in the last 5 years. Company has a good return on equity of 26% in the last 3 years. So you can look at this sales last year 23% growth. Uh, it has been consistent between 23 and 32% in the last 5 years. Profit growth, you can see average of about uh, 30% or 28% in the last 5 years. Yeah, 28%. Last 3 years, the profit margin has reduced. Stock price growth of 53%, which is good, which is driving a good value amongst the investors in the market. Return on equity has been steady at about 25-26% in the last 5 years, so which is a good sign. Then you can see reserves have grown by about 40 crores, 39 crores. Borrowings have increased. Higher borrowings lead to higher interest payments and directly impacting the bottom line. So, if the additional borrowing helps in generating business and generating revenue and net profit, then it's worth it. If you can see here, the net profit has grown by 26% in the last 1 year. So, business has also grown. So, extra borrowing and extra expense for the interest would justify as long as is able to generate profits. 32% public holding is pretty high. So again, in terms of volatility in price and in terms of volume, would impact the company a lot. The last company for today, Tejas Networks. You can see the current price of about 706 rupees, minus 5% return in the last 1 month. 40% negative return in the last 6 months and 50% negative return in the last 1 year. So, company incorporated in 2000, design and manufacturing wireless and wireless networking products with focus on technology innovation and R&D. TNL carrier class products are used by telecom service providers, utilities, governments, and defense networks in around 75 plus countries. Company is currently as a part of the Panatone Finvest Limited, a subsidiary of Tata Sons Private Limited. So, a Tata company here. Uh, You can see price of 702 crores, market cap of 12,400 crores, uh, high of 1,495, price to earnings ratio of 28, which is slightly on the higher side. Book value 218, so company is trading at almost 3.3 times its book value. Then dividend yield of 0.36%, return on equity 13%, face value 10 rupees, good median sales growth of 34% in the last 10 years, good profit growth of 31% CAGR over the last 5 years. So the major concern is the low return on equity of 5% in the last 3 years. Company has high debtor days. You can see here revenue has been erratic, so really we won't go into the details. You can see the last quarter the company has ended up in a loss. The previous 2 quarters are good, and subsequently a mixed bag in terms of revenue and profitability over the year. Overall, you can see on a year-to-year comparison, there's a huge jump in the revenue between FY24 and FY25, so almost 350% growth in revenue, and profit growth is almost 700%, which is a very good positive sign for a company in terms of profitability and revenue, and which should give a substantial boost to the overall value generation of the company. However, since the stock of the Tejas Networks is highly overpriced, and there was a market correction which happened in October, November last year, there has been a negative trend, and instead of giving positive return, the company has ended up with a negative return of 50%. So however, with the current the progress of the company in terms of revenue and profit, there seems to be that overall in the long run, you would see about 10 to 15% definite growth in terms of net value over annual growth rate of 10 to 15% over the next 3 to 4 years, and you will see definitely that the stock could start rallying up again. It may be a matter of a few quarters before you can start seeing some momentum again in the stock. However, it's important to note that investing or in this company, you need to keep a long-term horizon, and it would be best to consult an expert in this, as it is a company which deals with network projects and offers network solutions to various different countries. So definitely network development of products which can help in the defense manufacturing sector and overall telecommunications sector is going to definitely help, uh, and business would definitely grow. uh, However, it's just a matter of time, and a little bit of patience is required there. So, friends, thank you for watching. You can see again here, promoter holding is 53-54%, and public holding is substantially high as 33% here. So, there are chances of high price volatility and high volume volatility in this company as well. So thank you for watching, friends. Wish you a happy weekend. Please share this video with your friends, family, and associates who can benefit from this information. We'll connect with another video very soon. Please share your feedback on ways to improve the overall content, and we'll connect with a happy week ahead in the future. Thank you.